Hello, thanks very much for joining this Basis Period Reform webinar. The idea behind this webinar is really to go through the implications of how this is going to affect your 23-24 tax return. So we will try and take things step by step, and it's very much through the eye of the musician client base that we look after. So basis period reform is coming into full effect in the 24-25 tax return, but there are transitional rules in 23-24's tax return. In other words, the tax year that's just about to end on the 5th of April. So that is really the year where all of the changes take place, and we're going to cover how this will impact the profits that you're reporting in your 23-24 tax return. What are the practical steps you can prepare just to get your records ready to send to your accountant and your tax advisor? What tax planning options are there in terms of these additional profits, as you will see, that are coming into the 23-24 tax return? How can you tackle those? How will these extra profits, increased profits, interact with things like high income child benefit charge and student loan applications, how your household income is assessed, for example, in the context of student loan applications and all of that sort of thing. So the first thing we need to cover is what exactly is a basis period and how is it being reformed. So in any given tax return year, you'll report your self-employed income alongside the other sources of income like land and property maybe, or bank savings interest or dividend income. All of that will go into your tax return as usual. But the critical bit is that the self-employment year will be reported for the 12 months that end with the date that falls into that 23-24 tax return year. So, for example, if in the past you reported your income for the 12 months to the 30th of April every year, then your year which ends on the 30th of April 2023 is the one that falls into the 23-24 tax return. So that becomes the basis period that is taxed in the 23-24 tax return. That is your self-employed year of accounts that go into the 23-24 tax return. What's happening now is that the basis periods are being reformed. So actually, the period of income and expenditure that's being reported in any given tax return actually lines up with the tax return dates itself. So they line up with the tax year. And as I said, that system is going to be fully in effect by 24-25, but there is a kind of catch-up period that has to happen in the 23-24 tax return where you'll report your standard year of accounts, just as you've always done, but you'll also have this transitional period, which is this extra period, which starts from day one of your new accounting year and takes you up to the 31st of March or the 5th of April. And that additional bit of transitional profit is also being brought into your 23-24 tax return. And just a little note about 31st of March or the 5th of April. From HMRC's point of view, those two dates are entirely interchangeable. They don't mind, or any date in between for that matter. So I tend to talk about the 31st of March, but actually it's just as applicable to the 5th of April. So what will this actually look like? Let's have a little example here. If you've got a sole trader who reports his or her year end to the 30th of April 2023, then in the normal course of events, they're expecting to report their profits, their income, less their expenses, from the 1st of May 22 to the 30th of April 23. That's what would normally go into the 23-24 tax return. That's what they'd normally expect. But now you're going to have additional transitional profits from the 1st of May 23, which is day one of their new accounting year, going up to the 31st of March 24. And as I said, 31st of March or the 5th of April 24. Either one is absolutely fine. So there's this extra period of transitional profit that's being brought in, and you can report that additional profit in one of two ways. Either you can change your year end and bring it all the way up to the 31st of March 2024, and you have a long period of accounts. Or you can continue with your existing period of account. Let's say it's the 30th of April, and you will apportion the relevant months from each accounting year into your tax return. So in the case of the 23-24 tax return, you'll have your standard year, and then you'll have 11 out of the 12 months for your year end that goes to the 30th of April 2024 will also be brought in as transitional profits into your 23-24 tax return. So that year that ends on the 30th of April 24 will have 11/12 of the year applied to the 23-24 tax return. And that's the case for a 30th of April year, or for example, if you've got a 30th of June year, it would be 9/12 of that year, because that's taking you up to the 31st of March 2024, that will be brought into the 23-24 tax return. Okay, so let's look at another example just to begin to highlight some of the issues that are going to come out of this. If you've got a sole trader with a 31st of December year end, then the usual process will be to report 1st of January 23 to the 31st of December 23 in the 23-24 tax return. But now they're either going to have to move their year end to 31st of March 24, or they will need to report 3/12 of their accounting year that goes to the 31st of December 2024. In order to report 3/12 of that year to the end of December 24, you have to get to the end of December 2024. So that, of course, puts a real time pressure, because you're supposed to report 3/12 of that year in the 23-24 tax return, which is due 1 month after your year end on the 31st of January 2025. So that puts quite a lot of pressure on the timescale for that year of accounts that's ending 31st of December 24. In order to do that, HMRC will allow you to make an estimate, which you can then update by submitting an amendment when you have finalised your year to the 31st of December 24. Or, as I said, the alternative might be to consider changing your year so that it lines up with the tax year. So that is really what we're talking about here. Okay. If you decide you don't want to change your accounting year and you need to keep a non-aligned accounting year, as I've said, you might need to amend you will need to amend your tax return once the final profit figure is known. So once your 3/12 of your year end to 31st of December 2024 is actually a known quantity, you will need to go back and have another look at your 23-24 tax return, because those 3/12 that you estimated in order to get your 23-24 tax return in will now need to be updated. HMRC will allow you to make this amendment at the same time as submitting your 24-25 tax return. So that eases the admin burden somewhat there. How are these extra profits going to be taxed? That's really the question we all want to ask. So the standard part is taxed under the normal rules, business as usual. The transitional part, which is the extra bit of profit, is also going to be brought in. And then against that, you will deduct overlap relief, which is a relief figure that's existed in your accounts back from the early days of self-employment, most likely. And you will be able to deduct that overlap relief. It will create an additional amount of profit, which is not the full amount because it's been reduced by the overlap. And then that can be spread out over the next 5 years to try and mitigate the tax bill on that somewhat. So overlap relief is really your friend in this scenario. We'll talk a little bit more in due course about how to find that overlap relief figure, where it is, and what you need to do. Okay. One of the key things you really need to know about overlap relief is that the 23-24 year is a use it or lose it year. If you don't use your overlap relief in this year, it will disappear completely. So do make sure that you take advantage of the form that we're going to show you a bit later on. If you don't know your figure, get in touch with HMRC and ask them to supply it to you. So let's have a little look at an example. I've chosen a 30th of June year end for practical purposes here, and I've made the assumption that the normal profits for the 12 months up to the 30th of June 23 are £40,000. That's your income after expenditure, so that's your taxable profit, it's 40,000. We know that you're going to have to bring in 9/12 of your year end to the 30th of June 24 into your tax return. We're going to assume that it's exactly the same profit of 40,000 for the next 12 months. 9/12 of that takes you to £30,000. So now you're looking at profits of £70,000 being brought into your 23-24 tax return. But before you assume that, you need to take a step back, because your overlap relief will be deducted from your transitional profit figure of 30,000. So that £10,000 of overlap profit will come off the 30, leaving you with transitional profits of 20,000. Though that 20,000 figure does get brought into your 23-24 tax return alongside the 40,000 figure. If you look at how this is taxed, there's your 40,000 less your personal allowance, brings you to £27,430 of taxable income, taxed at 20%, equals 5,486. Then HMRC want you to take a second go at your tax calculation and look at what your tax calculation looks like when you bring the entire figure, so the standard part of your profits and the transitional part of your profits, which is that extra 20,000 in. So now you're looking at £60,000 of profit being taxed in your 23-24 tax return, less your personal allowance, taxable income of 47,430. Not surprisingly, that's generating a much higher tax bill because this tax amount here of 11,432 has a hefty portion which is being taxed at 40%, and that's what's pushing your tax bill up. The difference between these two figures is 5,946, and that is the additional tax burden that's coming out of this. Class 4 NIC is also chargeable on this. But this extra tax can be spread out over the next 5 years. If you decide to use 5-year spreading, then it will be spread out over the next 5 years. A few things to talk about with spreading. So if you have losses, if your transition part of your profits, once you've taken out your overlap relief, actually takes you to a zero or a loss figure, spreading is not available. If the main part of your profits, in other words, your standard year, and then you add your transition less your overlap, takes you to a loss figure, also spreading is not allowable in this scenario. But to be honest, for the large majority of clients, it's not, this lack of spreading in these two scenarios is not going to feel like an issue because your tax bill, in essence, will still be somewhat reduced because of the loss in one area or another. Do have a think, though, if you're close to retirement, because if you get to the end of your sole trade period and you close down your sole trade, then any remaining period of spreading that you've decided on is brought into that final period of account. So that might bring quite a chunky bit of profit into your last period of account. So do have a think about how to manage that and take a bit more advice before you make any decisions. The big question is it worth changing your year end, or do you want to try and stick with apportioning months from two different accounting year ends into a tax return? My recommendation is that for most people, for our client base, changing your accounting year is going to be the easiest option. But for some of you, and one of the key groups for this is that it's not terribly practical if, for example, you've chosen a 31st of December year end because you're also reporting income and expenses and accounting profits in other tax jurisdictions. So, for example, if you're regularly submitting an American tax return or a German tax return, then you may well have chosen the 31st of December because that alignment is necessary to make everything work across tax returns in multiple jurisdictions. You might not have the flexibility to change back to a 31st of March year end. And if that is the case, then you are looking at the apportionment options. That in turn will mean you're looking at an annual amendment, most likely, of your previous year's figures once your next year becomes finalised and you know the exact profit figure, because you will almost certainly have been estimating the profit figure for the first 3 months of your latest year of accounts in the previous tax return. So there's an extra admin burden there for both you and for your accountant or your tax advisor, and that is something to really consider. The financial impacts of all of this, it will have an impact on your personal allowance. So, for example, if your income, when you add your standard net profit, and your transitional profit figures, if you add them together and you find yourself in a scenario where your income exceeds 100,000, you will find your personal allowance is tapered. So you will be hit by a hefty tax bill and a higher effective tax rate when that happens. Student loans, as I said earlier, the increased income will be assessed for household income, and it will be assessed for bringing you into a repaying your student loan situation. It's a fair bit of extra work involved for both you, preparing additional accounting, income and expense records for your accountant or your tax advisor, and a fair bit of extra work for your accountant or your tax advisor as well. And the final thing to mention in terms of financial impacts is that it will also have an impact on your payment on account. So those higher profits being reported in your 23-24 tax return will knock on into your payments on account. And likewise, if you choose to spread those profits over the, let's say, 5 years that you're allowed, then as you approach the end of that 5 years, your payment on account for year 6 will likely be a bit too high. You might want to adjust it down because you'll no longer be including a spread of transitional profits that go back to this point in time. So the overlap profit relief figure is the saving grace that I mentioned earlier that you really need to find. There is a link here to get that figure from HMRC. In order to do that, you submit their G form and you'll need to know the date or the tax year when your trade started. And that might be on a very old tax return, or it might be just something that hopefully you remember, because it is going to be asked as part of their form where they ask you for information, and then they will come back to you in a couple of weeks, hopefully, with an overlap profit relief figure, which you can then use in your 23-24 tax return and in the calculation of what your transitional profits should be. So that takes us to the end of this webinar. Please do feel free to get in touch with any questions that you have. It's a fairly complicated piece of tax accounting and compliance for all those sole traders who are affected by this particular bit of legislative reform. So we're really trying to make it as accessible and understandable for you as possible. We're really happy to answer questions. And one of the key things I would say is get in touch with your accountant or your tax advisor as soon as you possibly can, so that they can help you plan how to cope with this, and maybe more importantly, so that you have a good indication of what your likely tax bill is going to be in January 2025 and beyond.